Market timing is a critical aspect of how to invest and how to make decisions based on where the market appears to be heading. Obviously, it's impossible to perfectly predict the future. If we could do that, then we'd all be very wealthy people. But there is a way to use various market indicators to gauge the overall health of an uptrend to determine when it might be topping and react incrementally in real time as you see market action unfold. Nothing goes up forever. Things need to come down eventually. Stocks need to pull back after strong periods of growth. And if you just blindly follow a buy and hold approach through bear markets and pullbacks and don't use rules for when to sell stocks, you're likely going to see a big portion of your gains disappear. Bottom line is, understanding how to handle uptrends and their pullbacks is critical to your investing success. That way, you know what's normal action versus abnormal action and how to adjust your portfolio accordingly in any scenario. As IBD founder Bill O'Neill said, you absolutely must have a proven, reliable method to accurately determine whether you're in a bull or bear market. So let's start with the first premise of market timing. The goal is not to get in at the very bottom and out at the very top. That's nearly impossible to achieve, no matter how good you are at market timing. Instead, it's better to think of market timing as making money in the early stages of a new uptrend and protecting your gains as the indexes and stocks start to weaken and slip into a correction. Your job as an investor is to be on the lookout for signals of a weakening market when the market is strong and signs of a new uptrend when the market is weak. There are a handful of tools and indicators we use to make these kinds of calls at IBD, and today we're going to focus on a very important one, the distribution day. Let me explain. The market is the sum of buying and selling decisions by millions of money managers, both institutional investors and individual investors alike. And lucky for us, there's a way to track on a daily basis instances of unusually strong professional selling on the index level. When the big money rushes for the exit, it shows up prominently in price and volume trends. This is what IBD calls distribution, or notable selling accompanied by meaningful volume. Distribution, like everything, is good in moderation. 1 or 2 days of it is healthy, even for the strongest of uptrends. But if the market starts to go overboard with distribution, it can be a real problem. The technical definition of a distribution day is defined as a loss of at least 0.2% without rounding up by a major index, while volume ticks higher than the prior session. Tracking the accumulated damage is crucial to gauging the market's health and forecasting a possible pullback. Distribution days are almost always a sign that the bigger funds are exiting the market, since these institutions control the bulk of daily volume and therefore the overall market's direction. You can't expect stocks to rise without those big players on board. The next question we must ask about distribution days is, how many is too many? The market can usually withstand 6 or 7 distribution days before rolling over. However, there are times when the market takes on upwards of 8 or 9 distribution days, yet is still able to move higher. Generally speaking, a decent-sized handful of distribution days in a short period of time, usually 25 trading sessions or less, can kill an uptrend. This is what we call a distribution cluster. So we must watch for these distribution clusters to know if the market is possibly topping. But the 25 session marker is key, as distribution days will eventually fall off the count. After 25 sessions, a distribution day expires and falls off the count by 1. A second way distribution days can fall off the count is for one of the indexes to rise 5% on an intraday basis from its close on the day that the distribution appeared. And finally, for another way the count could be cleared is through a proper market correction and new follow-through day. When the market falls into correction, the next big question is when it will regain its uptrend. When a follow-through day arrives, signifying a new uptrend, the distribution day count starts clean at 0 for all 3 indexes. So let's take a look at an example of the distribution day count in action. Looking at a chart of the NASDAQ towards the start of 2022, we can spot a cluster of distribution days that cropped up before a serious downturn. The NASDAQ was floating near highs at the end of 2021 after a powerful rally. From the start of that year, Through the high on November 22nd, the index had gained over 26%, but warning signs soon emerged, giving investors reason to adopt a more cautious stance. First, on November 22nd, 2021, there was a downside reversal and heavy volume loss of 1.26%. Next, November 30th shows a decline of 1.55% in volume, heavier than the prior session. The next day, December 1st, did not count as a distribution day because even though volume was above average, it was not above the volume from the prior session. December 3rd then delivered a 1.92% loss in heavier turnover than the day before, followed by 2 more distribution days in a row on December 13th with a loss of 1.39% and December 14th with a loss of 1.14%. By this time, the market had racked up 5 distribution days in a 16-day period, which should raise the caution flag for traders. The index then attempted to bottom and move higher in weak volume. It couldn't get back to prior highs before rolling over again. The next distribution day came January 4th, 2022, with a 1.33% heavy volume loss. By this time, that first day of distribution in this cluster fell off the count due to the 25-day rule, leaving the total count at 5. The next distribution day occurred on January 18th with a loss of 2.6%. By this time, the index was undercutting its 200-day line and in a sharp decline. Meanwhile, several distribution days fell off the count, now leaving the total at 4. 2 days later, another distribution day occurred on January 20th with a loss of 1.3%, then another on January 21st with a loss of 2.72%. The distribution day count remained at 4 as 2 more fell off once again due to the 25-day rule. However, on January 31st, there was an official follow-through day, which reset the distribution day count back to 0. 2 more distribution days occurred on February 7th and February 10th, with losses of 0.58% and 2.1% respectively. Then another distribution day occurred on February 11th, when the Nasdaq fell 2.78% in heavier volume. The final nails in the coffin occurred on February 17th, February 18th, and February 22nd, with losses of 2.88%, 1.23%, and 1.23% respectively. The distribution count had officially hit 6. These all occurred within 25 trading sessions. From here, the Nasdaq proceeded to deteriorate until it finally bottomed just above 10,000 in October. Traders could have used the distribution days at the market's November top to take on a more defensive posture and use subsequent distribution days in conjunction with the index's breach of the 50-day and 200-day lines as further signals of a weakening market. The late January and February distribution days signaled that we were in the kind of correction or bear market that was likely not going to recover very quickly. As individual investors, there's a lot of noise to filter out. It's impossible to read every earnings release or digest every weekly or monthly report on the economy. Watching the market indexes themselves is a simpler way to react to the next market decline or pullback in real time by way of using indicators such as the distribution day.